Farm for Profit Podcast. Take a listen, have a blast. Farm for Profit Podcast. Learn about farming while having a laugh. Farm for Profit Podcast.
And listeners, welcome back to the Farm for Profit Podcast. This is Tanner.
Tanner is here. No, Corey's here as well. I just did what you did.
How much of that chemical that you've been spraying have you been inhaling?
Oh, you're not supposed to drink it?
Oh, it looks like Kool-Aid. No, it does not. It does not look like Kool-Aid. But no, audience, thank you. We appreciate everything that you do, all the parts that you engage with and the messages that you send in. Remember, if you want to suggest a topic, it's farmforprofitllc@gmail.com. You can also text us 515-207-9640. We got an email from Greg. He said, I don't know how you ever showed up in my podcast menu, but last year you did, and I really enjoy every one of your podcast shows. It helps me keep up with the Midwest and my son in Indiana, who works in biologicals. So he is actually an Oregon listener.
Oh, and we asked people from
We
Oregon
did.
to tell us if you were listening or not. So thank you for
right.
that.
He's got a great story that continues to go on and tell us here in his email. But really appreciate all of you, whether you're from Oregon or Nebraska. You all matter to us. And we're excited to share more of these awesome topics that you bring to our attention. Today, we're going to discuss part of the conversation we had a couple years back. Dave and I did about this topic at the Commodity Classic.
I remember listening to the show. I remember seeing you guys up on stage, but I was not a part of the conversation, so I'll be learning for the first time.
And I do. And it's going to be nice to get an update here because you, as the audience, were definitely a big part of the success of the direction this is going. So all the way from Arkansas. He did not drive. He flew here today.
You had Nebraska plates on.
I rented a car.
In the car, that's
Yeah.
right, yep.
Yep, I could make so many jokes about Nebraska cars. But we're not going to. We have Ethan Branskin.
Yep.
I nailed it.
Yeah, you got it.
I didn't nail it
Yep.
the first time.
No.
That's right.
Way
That's
off.
why you take a practice run. So
You are the partner and director of Farmland Investments at Sower.
that's right.
I know we spent like 10 minutes the first time explaining what the difference between sower and sour. And the audience already has that covered.
There we go, yeah.
So we're good to go. But welcome to Iowa.
Yeah, thank you guys. It's great to be here. It's always a pleasure to get up to the Midwest, get up to the heartland up here in Iowa. So appreciate you guys having me on.
So you flew just for this?
Yep, just for this. That's what I was telling Tanner. You guys are. I mean, this is a big deal. This is a big podcast. So it's worth the trip.
Yeah.
So
Yeah. And I'm coming in 10 minutes late, covered in chemicals and, and sweaty and all that. So
Yes, last spring we had Eric Bueller.
Mhm.
He came on to talk about the Legacy Farmland Fund. So we're going to now give our audience kind of an update as to what's happened since then to today, correct?
yeah,
So
absolutely.
dive into that and get us caught up.
Well, let me go into that. So, we've taken a lot of different marketing approaches, trying to figure out the best way to evangelize this new fund. And so far, Farm for Profit podcast has been one of the best tools that we've had engaging potential, customers and prospects into the fund. And actually, our first deal came from a listener, an Iowa listener, Iowa farm family that listened to that podcast last spring, or the spring 2 years ago. So first of all, thanks for the opportunity. Thanks for the platform, because it worked out great for us. And yeah, I just wanted to jump back on now and kind of, after we've had our first deal come into the fund, kind of talk about the case study that we've learned, like from it, what kind of people that are, what kind of interest we're getting from farm families, what the typical situations look like that fit this model that we're taking on, and yeah, just have that conversation with you guys today.
And-
So are you sandbagging here? Are you the family that used the fund?
no, not me. No. I wish I had that kind of money. No.
Oh.
I want to know because we've picked up a lot of listeners from then, and some people don't listen to every episode. So for those people that haven't heard that first episode, just give us the elevator pitch of like, how does this work?
Yeah. Well, let me just give another brief high-level overview of Sower and our firm and what we do. We're an alternative investment platform based out of Omaha, Nebraska. I'm like you said, I'm based in Arkansas. I live on our family's farm in North Arkansas. So I work remotely for the firm, but we're invested in farmland in a couple different ways. We have one fund that we raise investor capital. We go and purchase farms and lease it back to partner tenants on those properties. And then our other fund is an exchange fund that allows for landowners to become investors in the fund, but by exchanging their land directly into the fund. So how I kind of explain that is, instead of selling your farm, paying capital gains, and then you have this cash and you're like, what do I do with it? Maybe I'll go put it into this mutual fund or a farmland fund. You just take that farm at that value and you exchange it directly into it. So the farm becomes an asset of the fund, and now you're an investor into the fund as well.
Okay.
You get those ownership units of that fund. And we, as the asset manager, we manage everything with that asset. We handle leasing it, handle the farm management, all the portfolio management duties of it, and that's kind of how that works. And the mechanism for that defers the capital gains is called a 721 exchange. That's how you take that land from farmland into the partnership that is the fund. So
So a lot of our listeners probably heard us talk about the 1031 exchange. This
That's
is
right.
The 721.
that's right. So 1031 is you got to go from land to more land, and you can defer capital gains. This one you have to go from land to a partnership to
Okay.
defer the capital gains.
So is there an 831 and a 931
I don't know.
between the 7? I guess it's a 721
Yeah.
and a 1031. 1020 10. I got my
I'm
numbers.
Is
sure
there
if
an
you read,
exchange
I'm
for-
sure if you read the tax code, there's probably a 722 and a 7. I'm sure that tax code is pretty
Oh.
lengthy that goes
Okay.
all the way to 1031. But yeah, I guess in farming, it's so far as I understand it, there's only a couple that you can really do to defer those capital gains.
1031 would be like kind investment, and then this
Yeah.
would be into a partnership. Okay.
That's right. So like one thing I tell people is the 721 is not new. It's not like this is like some brand new
Right.
thing or whatever. It's been around for a while. You could have always exchanged your ground into a partnership. So like if you're a farm family, and for whatever reason you're redoing your corporate structure, and let's say you owned it individually, and you're like, well, we need to change that ownership. Well, the tax code allows you to take your land into a partnership without paying capital gains. That is a transaction that has to take place, but it doesn't make sense. You don't want to pay capital gains on that. Or any
Right. That would
tax
be
burden.
dumb. It's still the same people
Right.
operating it. It would
That's
deter
right.
people from doing it.
So this is the same code that allows you to do that, but there's never been a professionally managed investment vehicle that people can do it into. So this allows you to do it while staying invested into farmland, and you become a passive investor at that point.
So are the only ones who do this? For
We're the
farmland?
only ones that have a pure, straight 721 farmland fund. There's a firm out of Wisconsin that does it for commercial real estate, and has grown it to over $1 billion. So it's not new for other asset classes, but it hasn't really been widely utilized in farmland. And as we'll get into talking today, like there's a lot of benefits that it can add to farmland and farmland owners that it's doing for other asset classes like multifamily or commercial. And so what we're trying to do is just add this product as an option for farmland owners and farm families as they go through different succession planning or transitions with their farms.
I can see your head's already working. You actually have your calculator open on your phone and on your watch.
That's an old school watch. I have not seen a watch like that in a long time. But
It's a
that's
new old
impressive.
school. It's a new
Is it?
version of the Casio, calculator watch.
Yep.
That my dad had. My dad had one growing up, and I
My
always
dad
wanted
had one. That's right.
And they would never allow me to have it because that would be cheating in school.
That's
So
right. Yeah.
Uh-huh.
Now I can cheat on the podcast.
That's a flashback. It's impressive.
So what'd you just math out there?
I pulled up my calculator and I put in 100 because I want to go through a scenario. If I have 100 acres and I throw in to Sower, how does it? Well, first let's talk about what would I do? I talk to you first,
Yeah.
and it's just as easy as like, hey, I want to take this 100 acres that I own and put it into the partnership.
Yeah. So there's always a question of valuation. Like people always ask about that. It's like, well, what value does it come in at? And what I always tell people is, well, it comes in at market value, and everyone's like, well, what's market value? But I mean, that whole deal is like, we arrive at market value with the landowner, right? It's like they may think it's worth $20 million. Okay, maybe it is. What my job is to make sure that as land comes into the fund, it still has to make sense for the fund investors.
Right.
So like if it's a farm that's yielding 3% and like the fund's promise to investors is to meet a minimum threshold of 2%, which is what it is, and your farm, and you want to contribute your farm at a 1% cap rate, well, that doesn't really, we can't do that. Like we can't dilute the return to our investors for doing that. So that's where we look at properties and we kind of determine like, here's the value we can put at it. We do our analysis on like, well, what can we rent it for? What's the net income of the property back to the investors? And then we determine, okay, knowing all that, what can we offer? What valuation can we offer for this property for that?
So let's say it's worth $12,000 an acre. So it's $1.2 million. That's your investment into the fund, and then you can rent it back.
You can, yep. You can rent it back.
Are you then getting the returns off of just that farm, or then you're part of the whole fund?
You're part of the whole fund. Okay. So like as this thing grows out, like the benefits to some investors, you can think about some passive landowners that only own one farm, but if they want to own a broader portfolio of farms, this is an option to take your asset and put it into more, spread your eggs around to multiple baskets type deal. So yeah, you're not just invested in that farm. That farm becomes the portfolio into the bigger portfolio that is the fund.
So is there like a share price? Like what would $1.2 million
So
me?
So for this first deal, like the starting point, you kind of just pick a number. So $1,000 a share was the starting point. That's just like here it is today.
Right.
We revalue it every quarter. So like as we get into this third quarter, we'll look at the farm. You look at the financials of the fund, and we arrive at a share price for the fund at that point. So this third quarter, it could be $1,005, okay, or it could be $995, depending on whatever happens. So we've already set like the initial point, and now it will flow with the asset. So depending on what happens with farmland values, will determine what happens with the price of the shares, essentially. So that's one thing people ask is like, well, if I put my $1.2 million farm in, is that I'm locked in at 1.2 million like forever? It's like, no, you still share on the asset appreciation of your farm and of all farms into the fund. So it's not like you're just like locking in that value.
Yeah.
You're still invested in the asset class and get the upside of appreciation.
And is there
hopefully never depreciation?
Right. So when you insert it into the fund, is it in there forever, or is there a set time?
It is an open-ended evergreen fund. So like there's no end date for the fund. There's no we have to liquidate everything after year 10 or whatever. It goes on as evergreen. It's in there so long as if it ever made sense for the fund to sell the property, we can't do anything without the original contributor's consent. So it is the intent is it for it to be in there for a very long time.
Right.
Like we don't have any other mandate for anything else to do unless it made like what we tell people is if 5 years down the road there's a farm that came in at $1 million and now it's worth $20 million and that was a huge benefit to all the investors in the fund, we would have to consider that and make a proposal for that deal. But if you as the original landowner, so long as the original contributor is still alive, they can say no. They can say we want to keep it as the farm. And honestly, if they're still renting the farm, I completely understand that, and that's one of the benefits of doing this deal is that it prevents it from any kind of commercial development. They still have a say over what happens on that farm, is the deal.
Well, I got a lot of questions. You want to keep going with yours, or can I jump in?
Go ahead. I got mine written down.
So if it's still up to that landowner and you're expecting it to be in the fund for a long time, I know looking at the press release that the shares are transferable. So if I die, my $1.2 million worth of shares can go to my next of kin. Do they become the new voice when you say as long as that landowner is still living?
That decision of control over sell or not sell ends with that original landowner. To prevent us from, like, if that landowner died and their shares were split 5 different ways, we can't split up 5. I mean, the whole point is to, kind of avoid family confrontation over stuff.
I get that. So if I'm if I'm the original landowner, I put this in 5-6 years down the road, I've got a grandson that really wants to do something that triggers me to pull it out. Can I buy it back?
Yeah, you can buy it back. Absolutely.
Okay. And is that a submit a form, make a request? Is it a violation of contract?
No, there's nothing. There's no violation with that. It would just be contact the fund, let us know what your intent is or what you're looking to do, and then more than likely, though, if that's an option for you, like on this first deal we did, we gave that landowner the first right of refusal to repurchase the ground, and actually gave him a purchase option on it because they wanted something a little stickier than just a ROFR.
Yep.
They're like, we actually want like a purchase option, so we gave them a 10-year purchase option on it, so they can trigger that at any point in time through over the next 10 years. So yeah, that's completely fine with if that's what they want to do. And I think a lot of people that think about this product or there's a situation where they need to use it, I would envision a lot of them are going to want that repurchase option on it. That's my guess.
Right.
Because I think it gives you comfort knowing that, okay, we're in this situation, we need to do this deal. There's a lot of benefits from a family dynamic to put it into the fund and get everything cleaned up.
Yeah.
But if 5 years down the road, my financial situation has changed, I would like to buy that family farm back. Like, I want that, and that's totally understandable.
Yeah. So that'd be what we call like first right of refusal. And it's always been a great point to me. I've always heard about first right of refusal, but I've never seen it been like enacted. So who determines the cost or the price of that? Because like, oh yeah, you get first shot at it, but by the way, it's tripled in price.
Yeah, I mean, on our equity fund, we always get a lot of requests from tenants. They want to do sales leasebacks, and then they want a right of first refusal on it. And what I typically tell them is, this is not necessarily how it would work on the legacy fund, but in that case, it's like if you want to buy it back, we have a certain return target for our equity fund. Let's call it 8%, okay, and we're catching a 2.5% cash yield off that. Well, then we need to get another 5.5% on an annual basis. So if you want to, whatever we're at today, if 3 or 4 years down the road, you can just go and add 5.5% each year as to what we would need to get to hit our return targets. We can't just hold it. We can't just hold it for free. We can't just hold it for free.
Yep.
Yeah, we can't just hold it for free. We're not just, we got our money's at work. On the legacy fund, we didn't establish a price on that for what it would come back to them at. But I told them the commitment was when you come into the fund, you're an investor, you're our client. We're going to work with you. We're going to try to get that deal. If you come in at market value, we're going to exit at market value. Okay, we're going to hit a price that works for us.
Yeah.
And also, like, you own shares of that fund, right? Like, if it sells back to you, you're going to get that benefit of it because you're a shareholder of that.
Yeah.
There's going to be a dividend paid out to you of whatever percentage you own of that fund. So, there's all the kinds of different factors to think about when that happens.
So this $1.2 million example, what if I've got debt on that farm?
If you have debt, it gets a little more complicated. We can accommodate it if there's some debt on the property, but probably a minimal amount. I'm going to say no more than 20-25% leverage on that property. And ideally, unless it's like, if you have a loan out there that's 3.5% that you made 5 years ago,
Sure.
and it's a 20-year loan and it's assumable, because a lot of farm credit loans are assumable, well, we may consider a higher LTV because the fund can just assume that debt. That's pretty accretive to us to take on debt at that amount.
Why wouldn't you just say it's 50%? Say you owe $600,000 on it. Why wouldn't, like, you're an investor, if it's a good price and you're willing to invest in it, just pay the money for that, and then the landowner can pay down that portion, and then they're only in for $600,000.
So think about this. Think about this on your example. It doesn't work that way, because when you contribute the farm in, there's no cash exchanged. Okay? So someone's got to pay off that. But there's transactions happening, and that bank has to be made whole for that debt on the property.
Got it.
So it would be up to us to extinguish that debt with
And you're not
capital.
in that
We can
business.
do it.
Yeah.
We can do it. That's what I'm saying. We can do it, but we can't take in if that debt is then incurred by the whole fund, all the investors of the fund. So those are just a lever we're looking at. Like, I'm not saying we can't do it. It gets a little more complicated. We have to do a lot more analysis on, like, how does this
It also
debt.
needs to cash flow. I mean,
It's
if you're
gotta
saying
cash flow.
50% LTV and you're supplementing off of other acres that you have,
Right.
they're not going to say yes because they're not going to take in a negative cash flow asset into their fund.
Which also means I couldn't go, hey, there's a farm for sale down the road that my neighbor offered me. It's, say things are going for $12,000 an acre, but they only want 10. I don't have the money. I can't go to you and go, hey, put this in your portfolio, buy this. and
Unless
I'll rent
they,
it.
so this hasn't happened yet, but like one thing we've always thought about is, okay, if you are someone that wants to rent some ground, if you knew that person and you knew their situation and they didn't need the cash or whatever, and maybe it made sense for them to go into the fund, you could come to us and say, hey, talk to these people about doing this exchange deal. Here's the benefits of it. And then you bring us a deal and you say, I want to rent the farm. Like, I want to rent the farm.
You get to rent it. You don't get any ownership in the farm.
That's right.
But
But
get
if you wanted to rent it, or if maybe that landowner be willing to give you a right of first refusal,
Right.
or say let him have the purchase option on
So
it.
is this how it's legal in Iowa for you guys to work? Because I'm pretty sure, I know Justin's fund or whatever, I don't know what you call these. I don't know the technical terms, but the anti-corporation ownership type stuff doesn't usually fly in Iowa.
Right. But in this case, it's a partnership, like this first deal right now. This is a partnership that's owned by an Iowa family. Like, the Iowa family farms it. The Iowa family is an owner in the entity that's formed as a partnership.
Right.
So
Which is why you're not technically buying the farm. You're
it's
assuming
owning it. Yeah.
ownership.
Owning it in exchange for the ownership units of the fund.
Yeah.
Yep.
So then, once I'm in the fund, how much control do I have over what else comes into the fund? Like, if I don't want any Nebraska ground,
You don't have a lot of control over that. I mean, we as the asset manager, we're ultimately analyzing and determining. We have an investment committee. So every deal that comes in goes before our investment committee, and we propose what we're wanting to offer for it. Here's the return analysis. Here's the benefit to the fund, and it either gets approved or
but you still get a
rejected.
vote.
You don't. Our investment committee does.
Oh, okay.
Unless you were a sitting member on investment
On the
committee.
committee.
Currently, there's no LP investors that are on investment committee. So, the investment committee is made up of 4 partners of the fund at Sower.
Okay.
So, do you have any use cases to kind of put this into perspective?
Yeah. So I think it's interesting. So let's talk about the first deal that came in. Like I said,
Yep.
Credit to Farm for Profit for giving us the platform. So Iowa family, eastern side of Iowa. I won't go in too many details because I don't want to disclose personal details and
Yep.
stuff, but let's just keep it broad. East Iowa ground, good farm ground. Family has been there for a long time. The dad farmed there for a number of years. He had 6 kids. Only one of those kids remained on the farm. The other 5 kids went off to do other stuff. They live in Missouri. They live in Minnesota. They live not on the farm. Okay. The son that remained on the farm built his whole life there. Okay, he has a son that's farming with him. So there's another generation there. There are multiple generations that have been farming this ground, and this guy's goal is that his son's going to keep on farming their family ground for a long time. But he has 5 siblings. Okay, and then the matriarch passed away within the last 18 months, and it was time for the estate to get settled up. Well, now you have 5 siblings with a minimal connection to the farm, 1 sibling who is his lifeblood, and it's his family's farming operation. But it's time to get everything settled up, and it's time. They want to get out. They don't want to own it jointly anymore. They're all in their 60s, somewhere between 60s and 70s as well, and they're ready to get their cash and do something else, do something with their own family with it. So there was a lot of disputes, a lot of squabbles, and ultimately the majority of the siblings were like, well, we're going to take it to auction. Like, it seems like the only fair way to do it. Let's take it to auction. And that way, and son that's farming, if you want to buy it, you can buy it at auction. Well, he's not necessarily in the best financial situation right now.
Right.
Okay. He's not that he's, in a terrible situation, but he wasn't in a situation where he wanted to take on, he didn't have the cash to do it. And he didn't want to take on a
Right.
bunch of debt to go do that. And he also knew if he didn't buy it, then his neighbor was going to buy it or someone else. And that farm's gone. Like,
Right.
he's not getting that back. So, son listens to the podcast. He contacts us and he's like, here's my situation. We're at a point where we don't have any other options. Like, we can't buy it. We can't let it go to auction. This sounds like this might be something that can work. So, went and met with them on the farm, talked to them, learned a lot about their situation, talked to the other siblings. It took a while. It took talking to attorneys. Then this is just, we learned a lot about how these deals, how long does it take to get these deals done? Well, it takes a lot of time. I'm sure, as you guys know, everyone in ag is open to new ideas all the time, right? They're all open to just
Right.
groundbreaking ideas immediately. So it took a while to talk to attorneys, talk to accountants. Like, this is how this is working. This is how this is all going to go. After a few months, we landed on the value. Everybody was comfortable with the value. We landed on the ins and outs of the purchase option, the right of first refusal, how these units were going to work, how they could cash out their units at the appropriate time, and eventually got the contract signed. And after 45 days or so, got the deal closed and first one on the books. I think the key points that everyone got everyone comfortable was that the son was going to farm it for a long term and give a 5-year lease on that to the son. Everybody got their own units, their own value. At the end, it was very much like the family's reaction was, "Hey, brother, hey, sister, like, we've done our duty as selling the estate, and we don't have to, like, there's nothing else that we have to, like, talk about or argue about or discuss. Like, you have your units, and when your time comes, you have the right to liquidate those units and get your cash." The interesting part you guys talked about, like, buying it back, I think definitely this family's intent is to, in time, buy that farm back from the fund. Like I said, they can't do it right now. We're almost acting as like a bridge facility for them. We're basically capitalizing out the siblings when they redeem out their units. We capitalize them out. That brother doesn't have to pay out his siblings. We do that, and it buys him time to get his stuff in affairs. Maybe, God willing, this farm economy turns around and or he sells something else, and he's more than likely going to want to buy the farm back. So
did some of his siblings cash out their shares right away?
So our typical liquidity holdout is a 3-year holdout on the shares. We can work around that at different times. It just depends. We gave a little faster liquidity rights to one of the siblings. Most of the siblings
There's
were
always one.
Yeah. Most of the siblings had the attitude of, we have to get this settled out. We don't necessarily want to sell. We do like farmland as an investment. Like, we like the way this farmland is going for us. We're okay to wait a little bit longer to have the option to liquidate.
Right.
There was one sibling that's like, I need it. Like, we want it. We want it. And so basically they're first in line to get their shares liquidated out first. So,
and they didn't necessarily have the wrong idea of going to auction as the fairest, right? Because that's, if Dave was sitting here, he would say auctions, find
Most
the right
transparent,
value, whatever. Like, but that tears families apart because, usually you'd prefer something to be done without going public like that.
well, you would think, and I've got 3 siblings, we've got a family farm. I don't know how it's all going to work out, but I can imagine how difficult it's going to be someday to sort of sort everything out. Like, in a perfect world, you're like, yeah, we should be able to figure this out. But you know how it goes. Time goes on. You got spouses involved. You got kids involved. Everyone's got their opinion on how this should work and what's fair and what's not. And I think the tough part is man, it's hard for the ones that are on the farm. I think. I mean, maybe that's a biased attitude toward it, but I just think it's a tough pill to swallow when you're the one that's stayed on the farm and you're the one operating it. None of this would be working if you didn't stay and do it. And then, but they're still your siblings, and mom and dad built up that, that asset for the betterment of all the siblings. And that's just the way it goes.
If Elaine Phrase was sitting here, she would say, what is it? Fair is not equal and equal is not fair.
Yep.
The old mentality of is if there was 3 siblings, well, mom and dad wanted to split it up, a third. That's fair. But the person on the farm, or persons that kept that going, even if mom or dad was the one technically operating, but they'd maybe been there for 15, 20 years with that sweat equity, actually has probably right to more than the fair a third. Like, they have if you want to be right about it.
I'm going to side with you on this. Like I said, I could be biased about it. I'm one of 5 siblings. My older brother passed away, so there's 4 of us left, and I'm the only one back on the farm. There's nothing wrong with that. Everyone has their different career paths and different life pulls you different ways. But I definitely think there's a difference when you're there every day with your dad on the farm, keeping it going, especially if if the work still has yet to be done. And in small towns, when at some point I'll be the major caretaker for my parents, and I'm sure this guy was the same way with his dad. He was the one that was there, caretaker for his parents. And I don't know, not to get off on that, but
we did get pushback online a little while ago. It's probably been almost 6 months of someone that stated, but if that child's getting paid a fair wage, why are they entitled to something greater? Same thing. You may work for,
I would say because
for a company.
If they were not there for those, let's call it 15 years, that farm would have probably had to sell, maybe not 15 years ago, but maybe 10 years ago, or something would have had to happen.
Yeah.
And I would also say, what's fair? What's a fair wage? Because I'm still getting, I still get a salary from the farm to help my dad. As I have my own farm, but then he has his, and I do a lot of the work and management of it, so I get a salary for that side of it. I could go get paid a lot more elsewhere. It's a good wage. I mean, don't get me wrong, but I'm not trying to sit there and gouge them for anything. And my peers that I graduated college or high school with, are getting paid 3 or 4 times more of that. So what's fair?
let me ask you this though. I mean, farming can be a pretty isolating business, right? Like, man, I mean, this past winter in Arkansas, like it's not fun to wake up and feed cattle every day. Like when it's that, and we don't get near as cold as you guys get up here. Like I was gonna say, like when it's 10 degrees outside, you guys will laugh at that. But you do it every single day, and but like how much more? I think about for the parents when their kids come back, and I think it adds sort of a motivating factor to that parent, as opposed to if you farm and you have no kids coming back and it's just you in your late 50s, 60s, and it's just you on that farm, man, that's got to be pretty like tough, as opposed to, let's say you have one kid that comes back,
Yep.
or two kids that come back, or whatever. Like, it's got to be a little more motivating and keep up the little pep in your step, and let's go to work every day. This is, for the family when you have, kids that come back.
Yep. Makes sense.
So the way though you described that first use case, that's not something that is a solution to our listeners who are tenants of a farm and they find out that their landlord's ready to sell.
It could be. But I would say if the landlord's like, it all depends on what that option or what that landlord's doing. But in a scenario where the landlord's like, I'm ready to get the cash. I don't have a tax burden. He has a step up in basis.
I'm 85.
Yeah.
I don't want my kids to deal with land when
Yeah.
I die. I'm ready to turn it to cash.
And that tenant's like, hey, I'm about to lose this farm. Potentially, I can't buy it. We can still help out with that situation with our equity fund, our cash fund, to where, if you've got a landlord that's looking to sell, or there's, or maybe you need to sell to recapitalize, that's really one of the best opportunities for us to partner with a farming tenant, and we can go in, buy that ground, get you on a 3 to 5 year lease, give you some lease security on that, and keep you on that property. And it's interesting, we have not done this on the cash fund, but I get asked about it a lot. Everyone asks on the cash fund, like, well, could I have a right of first refusal to buy that? And I'm always like, yeah, you can. I've never, for whatever reason, it hasn't ever come up when we bought farms, but we'd absolutely do a right of first refusal on that property if it's a farm that you brought us. So tenants bringing us deals is really, it's one of the best, one of the best things for us. It brings us somebody that we know already knows the property. They know how to take care of it. They know the ins and outs. They want it, they treat it like it's their own more times than not. And it aligns our interests very well, on that. And it can be a great partnership for sure.
So 3 to 5 year leases, how do you vet your tenants? Do you have a qualified leasing program? How do you know that Corey's worth a crap?
We like to collect some financials on the front end. I will say a lot of how we figure out about a tenant is, we like to look at yield history. Like, okay, well, I can tell you a lot about how good of a tenant he is. Show me what your yields have been on these farms. But then there's a lot of word of mouth. We do what anybody would do. We ask for references. We ask, let me talk to your banker. Let me talk to a farm manager you've worked with. And those people can tell you pretty quickly what you got there. Mm-hmm. So,
why farmland? I mean, there's other stuff that is returning a lot better than farmland right now.
Well, I think anybody that's in farmland investments would say that the last 2 to 2.5 years has probably been a tougher capital raise from whether it's institutional money or family office money, just private money getting into the space, because the markets have been just roaring. Like, it's hard to go out there and say, to answer that question, like, why farmland when I can go out and get 20%, 30%? Like, look at my stock portfolio.
Even CDs,
not a bad,
right, are
riskless rate of return.
Better than farmland, right?
The riskless, the riskless rate of return is what, 4%, 4.5%, So, what I would say, comparing it to stocks, as you guys know, like, it just doesn't carry the volatility, right? Like, look what's happened this year when we start talking about there's tariffs, there's not tariffs, there is tariffs, no, there's not. And it's like your portfolio just goes up and down and up and down. But at the same time, farmland is just it's just steady. It's rock solid. There's less and less farmland every day, unfortunately. They're not making any more of it. In fact, it's getting developed into solar, wind, urban sprawl. I haven't seen a lot of apartment complexes torn down and go back into cornfields. It's just the way it is. But obviously, we know productivity has increased on farms for that. But I think the scarcity of farmland is going to always make it a great asset to have in your portfolio. And that's what I think the way you have to look at it. Like, it's a piece of your portfolio. It doesn't have to necessarily be, I'm all in on farmland, all my eggs in that basket. Because over time, it's still, a 10% return, on the average, 8 to 10% with your
Says
cash yield.
11.2 on your website.
Yeah. I try to under promise, over deliver. But yeah, so it's a great steady asset to have, I think, over the long term. And I don't think you'll find many people that have invested in farmland over a long-term period of time and said, I wish I hadn't done that. Like most people I talk to, and I was in banking before this. I spent 10 years in ag finance and saw a lot of people's balance sheets with how they accumulated a lot of wealth, and a lot of wealth accumulated on balance sheets from just having a dedicated investment strategy to farmland. So.
Yep. And yeah, it might only be 2 or 3% like for corn or soybean ground per year, but that's basically a dividend.
That's right.
Right?
Yeah, and you still have the asset appreciation.
And then you have the asset appreciation. Where if you just buy a stock that has no dividend, you will only gain. You might be up 50%, but you will only gain that if you sell it.
Yep.
That's right.
Right?
Yeah, our asset manager, Chris Zachevich, he ran a recent. We've been doing some modeling and kind of determining like where do we need to be placing our capital on our equity fund, and modeling out farmland returns. And when you look at the last 40 years of farmland, it's almost like the upside of it is, can be 15% return. Like that's kind of it could hit that. Like you could hit a year where but your downside is like 0% or 1, your downside is so low. It's almost just like you're probably never going to lose or rarely ever lose, but your upside is,
right
up there. And then on the average, you should be ticking along that 6, 7, 8% range, over a long-term period of time.
I mean, what if we sell or get into this fund, give you this 100 acres, 2 years down the road, corn, ethanol's gone. Like they just blow that up, and then all of a sudden corn's under $2. Like, how does that rent look? I mean, obviously, if stuff's in the crapper, I can't continue to pay whatever I was when corn was $5 or $4.
Well, in that scenario, yeah, dividends on farmland will likely go down. Like you're going to get less of a annual cash return on that land. But at the same time, when that's happening and land starts, land could go down, but there could be more demand for farmland. There could be more people looking for deals, looking to go in, more cash getting into it for whatever reason. There's always going to be cash looking for that solid asset class. I think it's.
That's a good question. So if I had cash, can I invest in your fund?
Into our equity fund, yes, absolutely. So if you got cash, and you're a private investor and want to diversify your holdings into farmland, we can accommodate that.
So at that point, you're just buying shares at whatever you determined the last quarter.
That's right. You're buying in at that, and we take that cash and we go to deploy it. Once we get enough cash accumulated to deploy, we deploy it into.
Is there a minimum investment,
50,
or is there a minimum acres?
There's $50,000 is the minimum for the check size to get into the equity fund. There's no minimum acreage amount to go into the exchange fund. However, one important thing that we've ran into on this is to come into the exchange fund, you have to be an accredited investor. So you have to have, if you're an individual, you got to have $1 million net worth, excluding your personal residence. And if you're a LLC, you got to have $5 million or more in assets.
So we're out.
Are we?
Personally,
Yeah.
and LLC wise, I guess.
The LLC part looks like it's a more difficult stretch to get to as far as that for the investor accreditation side of things. So then, do you have capital that's ready to deploy?
Yeah, we have capital. Like I said, we're pretty picky with the farms we're looking at right now. We have a limited amount of capital that we'd be looking to place in the next 2 quarters, but we do have some capital to place, and we would like to get more into the Midwest. Like we're pretty heavy in the South and Southeast right now. So yeah, we'd like to get more into the Midwest.
So a good Midwestern piece of dirt, decent
Nebraska.
No.
It's a good thing we got
Maybe.
editors. Maybe. Like close to the Iowa border if we're going to know. We like to give our friends in Nebraska a hard time.
What does the portfolio look like? You talked about this, your first deal, which couldn't have been that long ago. So have you done more deals since then?
We're still at one deal on the exchange fund.
Okay.
So we got one asset in that one. On our equity fund, we're at about 17,000 acres across 7 states in that one. We started in 2019 on that fund, so we've grown it each year to about 120 million in assets.
So there's an equity and an exchange
Yep.
fund. When you put your land into the exchange fund, are you part of the equity fund?
It's 2 different funds in terms of the asset pools on it.
Okay.
Managed the exact same way, like managed and operated the same way, but asset pools are separate on it.
Okay. So you're only getting the returns off that one farm right now.
Yeah. So that was what, as you go through the cycle of telling people about this, it's like, hey, it's a portfolio of farms, except it's going to be a portfolio of farms.
Yeah.
You kind of have to get the first one on board to be like, it's just going to be you today.
Mm-hmm.
Like you are the farm, like you are the
I
portfolio.
am the fund.
But ultimately they were okay with that, and this was what they needed to happen. They needed this solution, and so they were okay with the lack of diversification, I guess, on the front end.
But you got 17,000 some acres in the equity fund.
Yep.
What's the best returning farmland? Is it a certain region? Is it a certain crop?
On a cash yield basis, our best one right now is Louisiana. Southern Louisiana sugarcane is our best cash yielding.
Okay.
I would say overall yield probably been Nebraska. Irrigated Nebraska ground.
Irrigated.
Yeah, because they're cheating.
Yeah.
Yeah, they can control their yield a lot better. Although I know they're pretty dry. They're over there. They were watering. I mean, they always water, but they were watering corn up out of the ground, which is pretty early for them.
Right. Right. Absolutely. Well, for our audience, right, part 2, we'll make sure to link back to Eric's interview in the show notes so you can go back and listen to that. But we've got a use case. We've got good examples. We also know the way that you can help on that landlord-tenant relationship. Also, like you said, with the family relationship. Did we miss anything else that you think we should cover today?
I don't think so.
I got
Great discussion with you guys.
I got some rapid fires.
Yeah.
Do you have a target ROI per yield on, I guess, your dividend portion?
2% target, minimum target.
Minimum target.
Yep. Mm-hmm.
But probably, ideally, obviously, you want more. Right?
Higher than that.
Yep. How do you get paid? I'm assuming you take a percentage of management fee or something.
We get a management fee. We take a 0.5% management fee, and we do take a fee on the intake as well. So just like when you're doing a loan, there's you're always paying an application fee or whatever. We take a fee on the intake of the deal as well.
I always get the bank to waive that.
Smart.
Oh, you want me to pay you to use your money?
You want what?
You got a good buddy as a banker is what you get.
Yeah.
Is your farm in the fund?
My farm is not in the fund. We are a commercial cow-calf operation. So another key point, we're only taking row crop farms. We could take some farms with pasture land. It depends on the yield of it. Obviously there's pasture land that has rent that could work.
Yep.
But currently North Arkansas cow-calf operations on gravelly loam soils does not fit the return of the
You're-
fund.
so-
But I do think I've thought about this a lot. If we were a row crop operation, it would at some point in the future, like we would be a pretty interesting case study for this deal, and it would definitely be something I would strongly consider, and maybe even be the option number one, especially for a situation where, like, I think the toughest part about it is when you got siblings that you have to buy out.
Yeah.
It's like, what do you do? Well, you can take on debt or you sell it. And so if there was a situation in the future where our farm worked for a fund like this, and I had three brothers who are like, hey, it's time to cash out, then I think this is a great option for that.
If there was a farm that had solar or wind on it, it's still a farm. You're not going to allow that into the fund, even though if it had good return?
If it had solar and wind on it, it would not exclude it from being into the fund. It could still be in the fund. Yeah.
Right. Would you consider it if you took the farm in and didn't have solar on it, but then there was an opportunity?
Only if that landowner was okay with it,
Yeah.
the original landowner. So what we said on those cases is, like, somebody may exchange the farm into the fund, and they may not want that to ever be solar. Like, they may want to be, especially if they're wanting to farm it and lease it.
Right.
Like, it doesn't really work if they're.
True.
So that would be so long as that original contributor's alive, they would have to give us permission to engage in a renewable energy contract.
My last one, and then you can have it back, Tanner, is devil's advocate here. I can just see someone in the comments going, "You're killing farmland ownership by the small American farmer," or whatever. Something along those lines. Like, explain why it's not.
So I think, like, take this use case. Somebody may say, well, it should be like a free market, and it should just go to auction, and the next farmer should own it or whatever. But it may not be a farmer that owns it. Like, it could be another institutional investor that buys it at auction that doesn't give the same considerations to this family farmer that our option gives to them, right? I think in general, I mean, like I said, we own a farm. I'm pro farming family owning the farm and operating it. We come in where there's a need for a capital solution that operation doesn't have. Like, in this situation, there wasn't a great alternative for this family to keep this dad and son on the property. Like, ultimately, we're the ones that kept them on the property, keep farming it.
Yeah.
And we're giving them the option to buy it back once their situation has changed. So I really believe, like, we've really tried to structure this legacy fund to be as pro farm family and like do whatever we can to work with the clients and keep the farm family on the farm. So, but I think after Eric's podcast, I read some comments, and yeah, there's people, if you're an institution or something and you're investing in land or buying land, there's always going to be that sort of rhetoric out there. And I get, we're in agriculture. Everybody's skeptical of everything at all times. And sometimes that's to our benefit, but sometimes it's to our, it can be a negative for us to not be open to different solutions and new ideas. I think it's all about who you work with, and it's all about relationships and making sure you know who you're working with and dealing with. And if you're working with good people with good intentions and have a good relationship, then I think it's going to be okay.
We'll have to let Elliot and Louie discuss.
I think it'd be a good conversation for them to have.
Yep.
Down the road. But if we found partner number 2, how do they hook up with you guys or make a connection?
Yeah, so you can go to sower.com, SOWER.com. That'll take you to a landing page. You can find my contact information. So plenty of ways to contact us on our website, and we should be able to get in touch. So
great. Well, we appreciate you making the trip up. I do agree this was much better in person than it would have been digitally. So glad that you're able to pop in. And listeners, we appreciate you as always. If you got questions, make sure you reach out to those folks at Sower. Maybe this is something that can help you in your farm or maybe the future of your operation. So until next time, have a good one.